Yeah, if you have any comments or you're interested in any individual stocks, definitely leave them down below. And I will definitely try to get to them as soon as I possibly can. So, first thing is first, let's talk about kind of what's going on economically here. Let me shrink this down so you guys get a clear picture. So, what this chart is, I'm going to go macros here and we'll bring it down to individual stocks. So what this chart is actually delinquency rates of consumer loans, okay? So what we're starting to see here is delinquencies are definitely picking up, okay? So anytime we get a pretty significant spike in delinquencies, as you guys can see in the gray area, this is where we start seeing recessions taking place, okay? So spike here, and now we're coming from ultra low levels, and this is where it's going to get confusing, guys, because the way we have to think about this is we're really at ultra low levels when it comes down to default rates and ultra low levels when it comes down to unemployment. Okay, so there's a lot of dynamics taking place here. Okay, so we're getting a significant spike here in delinquencies, and that's causing concern here when we think about. My thesis was that earnings were going to deteriorate going into the end of this year, and we will be in a recession by the middle of next year. And I know a lot of people are probably tired of hearing this, but guys, the warning signs are there, and it's definitely on pace. And I'm going to go over the technicals and what I think is happening. I do, however, believe that there will be a decent bounce in this market, okay? With the VIX move, I do think we will see a possible bounce in this market, okay? And I'm going to go over the technicals really, really quick here. And then if you have any individual stocks that you guys want me to take a look at, feel free to put them in the comments and I'll try to get to them as soon as I can. So the 2 to 10 year spread, when that starts to normalize, guys, this is when the clock starts ticking here. And I would say, 8 basis points away from it normalizing. I'm putting a timer on the clock now and saying 6 to 8 months from now, I do think we will be in a recession. And I think it's going to be a lot uglier than everybody's anticipating, because of how fast the consumer is tapping out, and basically 70% of our economy is based on consumption. What does that mean? That means that technology is probably still going to outperform or maybe not sell off as much, but technology is really coming from inflated levels, in my opinion. And when we think about technology adapting to AI, there's going to be a lot of capital expenditures with that. So earnings are going to be an issue, I think, longer term as well for more of your technology plays. If we think about what's been outperforming, we'll get to that in 1 minute. But it's been really consumer staples taking the reins on that. So what you have in front of you here is a tick up in unemployment. We are now sitting at 4.3% unemployment. Does anybody remember where I said it's really going to get interesting? I said when we break about 4.5. Now, anytime we get a 50 basis point move in unemployment, that has triggered recession with 100% accuracy. Okay, so there is some signals here. We got the uninversion of we got normalized levels with the yield curve picking up. We have unemployment ticking up, and we have default rates moving in a very, very fast manner. People are now defaulting. And so what does that lead to when we think more macro? Okay, what did I say about SoFi, guys? I said sell it before earnings. Does anybody remember that? This was one that we talked about technically that was making a big move into the earnings. And I said that I don't think you want to own this going into earnings, because normally what happens is you get that big spike initially on the earnings front, and then you get the substantial sell-off following after. And we've done a million analysis on SoFi, and the analysis still comes out about the same, though, about a $5-6 range. They are doing a good job of growing book value, but what's the problem with their book value? Book value is not based on quality, right? And so that was the big issue I had with SoFi. So let me see here real quick. So that's not trying to knock SoFi, guys. That's me trying to put your best interests forward. Now, I'm not going to always be 100% right in my analysis, but what I try to do is really come into every day with an open mind, show you guys the process of how I'm arriving at these prices, and show you guys what I'm willing to put my capital in. And I don't think a lot of people are as transparent as I am. I'm never going to be perfect. There's going to be things I miss. The more things that I'm going to miss are things that have substantial valuations when you compare them to their peers. those become harder to measure. There's very few opportunities where I'm really looking to take on the risk of the deeper or the higher valuation plays like that. What I want to show you guys right now is what we're starting to see outperform here. Let me just pull that up really quick. And just everybody give me a thumbs up on everything here. I also want to go over Intel's technicals because I just dropped a video on Intel, and oddly enough, my price target matches up with some interesting technicals. So we're going to go over that as well, but I'm looking for something here. Okay, there we go. I wanted to pull up the sector tracker, just to kind of get an idea of what's outperforming here. I already know what it is, but I just wanted to show you guys over the last month what's going on here. So hold on one second. So we'll X off of these. We got charts ready to roll. I'm going to move this over. So over the last month, we are looking at an S&P 500 that is now down. Hold on one second, guys. Over the last month, we are now looking at an S&P 500 that is down roughly 3%, okay? Leading the way in that downward move is technology. Utilities is outperforming. Healthcare is outperforming. Real estate's outperforming. Consumer staples is outperforming. What do all those things have in common? Those are all sectors. Those are all sectors that are now what we consider defensive, and defensive as in we need them on a daily basis, not a lot of price action, low beta on these sectors. So very, very defensive, very kind of safe haven plays. And the underperformance of the technology has now driven the S&P down because the S&P has now basically turned into the triple Qs the way that's balanced out. I really, really don't like what's taking place with reinvested capital at this point in time. If you're invested in a lot of ETFs that are market weighted, it's a big problem in my opinion, because what we're starting to see is that dumb money is just there to keep technology propped up, and it's causing an overvaluation, and it's causing the market cycle to kind of get out of whack here. But if you're able to look past that and start picking individual names, there's some tremendous opportunities that are being presented in this market. Healthcare being one of them. Sean's on top of it. Energy's probably one you're going to want to hold. You might want to buy the dip on a good energy dip here. And how I would think about this, guys, is the initial knee-jerk reaction. The initial knee-jerk reaction on rates is going to be real estate outperforming, okay? But I want people to understand there is a substantial amount of small businesses failing right now, okay? And there's a substantial shift within the consumer where we're looking at more people now shopping from home. Big box retailers are not needed as much, and interest rates are still higher than they've been over the last 15 years or so. So even though we're looking at, a 10-year treasury trading between, I guess, right around 3.8, 3.9%, I do think we're going to find a bid in the 10-year treasury due to the amount of debt that's due for the United States. We're going to be issuing tremendous amounts of 7 to 10-year paper over the next 3 to 4 years because of that $35 trillion deficit that we're funding, right? So if we think about that, that's going to put a bid on the 10-year treasury. Where do I think the 10-year treasury is going to settle? It's probably going to settle anywhere between 3.5 to 4.5%. I think 10-year and 7-year treasuries are going to be extremely volatile. We already know that the Feds are going to be ready to cut rates probably sooner than later. I actually wouldn't be surprised if the Feds do an emergency cut based on what we saw with the unemployment rate ticking up as fast as it's ticking up. Anytime we see that 50 basis point move in unemployment, usually a bad signal. We got normalized rates and we have default rates picking up. All these things have been signaling to me that things are getting a little bit choppy here, and it's going to be a rough ride, guys. There's no doubt about it. We're looking at valuations trading in the upper decile. So even if we take our emotions out of the equation and we say that, Colton, you're completely wrong. That's not going to happen. We're not going into recession. The economy's too strong. Okay, I can get behind that. But then the next part of that equation is, are we going to have strong enough earnings to sustain a 22, 23 forward multiple when historically we trade at 18 times a forward multiple, 17 times a forward multiple, which is a substantial premium when we think about it. Do we have the earnings growth to demand that type of multiple going into 2025 and 2026? I don't think so, especially when we see the default rates picking up. The only area that can carry that is going to be technology, and we're seeing companies like Amazon and Google and even Microsoft not really outperforming to that substantial premium we're paying for them, right? So there is some cracks that are taking place here that I just wanted to share with you guys, that is still lining up with my thesis since day one, guys. If you've been subscribed to the channel since day one, we've been on top of this, right? We've said, it's been my thesis that 2025 is going to be a very hard year, both from an investment standpoint, but also from an economy standpoint. We both know, or we all know, that the true economy differs from economic activity sometimes. The true economy and true economic activity differs from what's taking place in the stock market, because the stock market is essentially a liquidity machine, and it doesn't always need to be that way for the true economy. So at one point in time, usually at peaks and troughs, do we see an economy really outperform when we're dealing with the economic side of the cycle right now? So here's what I want to ask everybody, and please put it in the comments, guys. Spam the comments on a stock that you're looking at. I'd love to know any stocks that anybody's looking at. Spam it in the comments. The other thing I want to ask you guys is, normally when you get a 5 to 6% pullback in a bull market or a bear market, if you get a 5 to 6% move, that usually signals either a top or a bottom. Okay, so this type of move usually signals a top or a bottom. The recent 1 month move usually signals a shift in sentiment. Okay, and so if I were to ask you guys, do you think we're at a bottom or do you think we're at a top? Because history would tell us that with the amount of volume and the amount of selling pressure and the movement that we've had in the indexes, a 10% move in the triple Qs, around a 5% downside move in the S&P 500 would usually signal a top, okay? And do you think we're at a top or do you think we're at a bottom at this point in time? And personally, I think we're at a top, and it's been my thesis that we're at a top. So everything I'm saying has been things that we've talked about for a significant amount of time on the channel. And I try to stay positive and be optimistic, but I just wanted to share where I think we're heading. And so let's break into the charts here, guys. And I'm going to give you how I think this is going to formulate and what I think is going to happen here. So let me just make sure you guys get this. I'm going to zoom in right here. We're going to stay focused over the last, this is a 1 year chart on the SPY. We have a 1 and a 2 count to the downside. And I want you guys to pay attention to this 180-day moving average, okay? I put that up because that's personally the average I like to use. I want to draw a significant trend line that I think is pretty strong, a strong trend line here that's had multiple touches on this trend line, which I like to look for 3 to 4 different touches on a trend line here. So I'm going to zoom in just on this one little area, guys, and I want to talk through exactly what I'm seeing. What I stated in my last live stream was a few different things. Number one, I said I thought we were going to have a sell-off in... Guys, I can't make these charts up. This has been drawn for a substantial amount of time, and anybody that participates in my live stream has been on this, guys. Like, I'm not a perfect chartist by any means. It's not where I really like to put my focus. But this is starting to formulate just as I stated. Okay, so I see a lot of people thinking it's a top. Thank you guys for spamming the comments. I would agree with you. I think higher probability we're at a top versus a bottom, especially when we look at historical valuations of the S&P 500. And what's taking place with the consumer, what's taking place with default rates, what's taking place with unemployment, and what's taking place with the inverted yield curve. I would agree with everybody that I think we're at a top. So with that being said, the last live stream we went through, I broke down SoFi to the T, guys, and I broke down Intel to the T. There was somebody who was on this live stream that talked about Intel and wanted to buy Intel, and I said it was around 33 bucks or 32 bucks a share, and I said that I would wait on Intel. Don't rush to it. I guess if you want to buy some covered or buy some cash secured puts around 30 bucks, collect a premium and maybe you get filled at those levels. But back to macro here. I believe we have a head and shoulders pattern formulating, and that's been my thesis on the channel for probably the last few months here. Okay. Last few months, I believe that we're in a head and shoulders pattern. What I believe is going to take place is we're going to hit this trend line and or line of support here. It has 1, 2, 3 solid touches on long-term trend. So we have a long-term trend line I think is going to get hit along with a 180-day moving average. If you guys want to average it out, that's basically a 200-day moving average, okay? So 200-day moving average and this trend line, I believe, is going to get hit, okay? So I believe here's how this is going to play out here. I believe we're going to hit this trend line, and I believe we're going to retest this and build out the right shoulder a little bit more defined and eventually break through by next year, okay? So how I think the rest of this year is going to play out is we hit this trend line over the next few days. So very, very small downside move, another 1.25% downside move. Okay, so we could even stop here, guys, in my opinion. What we could have happen is we could trade sideways and eventually that 200-day meets the daily moving average and we eventually rip back up, okay? Where we're going to rip back up is probably going to be the catalyst of a new regime changing in Washington, okay? That's kind of where I'm earmarking. So we get a few months of choppiness, probably up and down, up and down. I think we finally either hit another, call it another 1 to 2% downward move. And then I think we eventually regain the right shoulder build out here. I got a feeling that the top is possibly in on this market, guys. Okay, so I think the top is in on this market. I'm drawing a trend line because I do think that two things could happen here. I think either A, the top is in, or B, we form a double top, and it's going to trick a lot of people in thinking it's a new bull market. So how I think this could happen is we chop sideways. Maybe we come down another 1.2%. But I think we eventually start making our way back. And I do think we could possibly chop here. And here's what I want to point out. Let me downside this. This is how I think it's going to play out to the date, guys. I'm going to give you the specific date even. And then I'll get into individual stocks here. Okay. So do you guys see these red bars down below? These are high risk periods. These are high risk periods of money flow. Okay. So basically look at them as money flow peaks and trough. Okay. I don't have them dated perfectly, but they're in pretty good shape. So we test this top, I think, this crossroads here. And that puts us in line with a end of September kind of peak. I think we peak in September. And then we start trading sideways. And I think the real risk comes at the end of the year where we start making a downward move. Okay. And that's basically what I see for the overall S&P 500. So kind of just to recap on everybody here. I know most people are not into charts, but that's kind of how I think we play out here. So Sean says about a 7% pullback. So yeah, I'm guessing between historically, we normally get a 8 to an 11% pullback, Sean. Historically, when you get a 5% move, historically, it's usually an 8 to an 11% move that follows that. That 1.25% move basically gets us right around that 8 to 9% move down from recent highs. And then from there, I think we chop back up. And at that point in time, I think we're going to start seeing really choppy waters. I think we'll retest that, build out that right shoulder, possibly retest that that recent high of 564 on the SPY and maybe take it out slightly. And then I think the market's offsides at that point. And I think we have a rough end of year into 2025 because I think the market will be ahead of any sort of recession signals. I mean, if we really think about kind of if we really think about this more holistically, the bond market is screaming at us right now. The bond market is screaming at us that yields are too high. Okay, which the bond market's usually more accurate than the stock market, right? Stock market's driven off of liquidity and emotion. Bond market is driven off of really fundamental and more macro looking. So if we think about the bond market being a tail sign to the economy, the bond market's right around 90% of the time when we look at 2s to 10s, and it's right nearly 100% of the time when we look at 3-month to 10-year. So the bond market's been telling us we've been heading into a recession. The stock market's been telling us it's going to be a soft landing. Somewhere, something's got to give. And what happened to the bond market on Friday and what happened to the stock market, it looks like the bond market could be right. I'm not essentially saying that we're going to have a hard landing. My thesis is that we are going to have a hard landing because if you look through history, the Feds have really done a horrible job at giving us a soft landing. And right now, I would say the bond market's saying that the Feds are behind the 8 ball. And I tend to agree with the bond market based off of what we're seeing in the jobs data and based off of what we're seeing in default rates picking up. So with those two things picking up, it looks like the Feds are now behind. So even if they cut, they're already behind. What damage has those last few months done to the consumer, and what is it going to do to the labor markets? Because if the consumer gives out, the labor markets have to give out, because if there's not enough demand buying products, then you don't need as many employees, essentially, right? If we're really simplifying some things here. So, and then borrowing cost. So Nick, I believe small caps are not an area you want to be in unless you are, if you are picking individual names that you think have really good balance sheets and can handle higher rates for longer. Because even though we're seeing a tick down, we saw the 10-year really dive down, I do think we're going to still see a bid in the 10-year around 3.5%. When I think about the 10-year auctions taking place, I just don't know how we're going to issue all this debt without having yields kind of tick back up or have a bid underneath them. And when we look at historic companies that are losing money, this tends to be over the last 20 years still a pretty impactful rate. Okay. So that's just my opinion. You could bet on small caps, but if we take a look at kind of how small caps have done, I'll pull up small caps really quick. Actually, before I pull up small caps, let's take a look at Intel's. Take a look at Intel's chart, guys, really quick. And if anybody has any other names, I see TLT in there. TLT could be defensive. I think you've got the majority of your gains if you got in early on TLT, though. I think we're going to see TLT possibly trade sideways. You might get a little bit more out of it, but I think the TLT did its job. We'll pull up the TLT in a minute, actually. So that's a good call out. I'll take a look at TLT. What else we got? That's what the Feds want. I agree, Sean. The Feds kind of said that it was going to be, they said it was going to be tough, and it hasn't been, because the government has been stimulating while the Feds have been tightening. So it's kind of been a nice even keel. But the problem is the deficits that we're running is going to be a massive problem at some point in time. When does that start meaning something? Really, really hard to tell. So what I have up here is the disgusting chart of Intel over the last 20 years, call it. This has been a tough one, guys, because if you've been a long-term investor in Intel, you've suffered tremendously on the stock price. Yes, you collected some dividends along the way, but this has been a full round circle from they're basically trading 20 plus years ago at prices they were 20 plus years ago. So I did a video on Intel today, guys, and if you haven't seen it yet, please consider taking a quick look at it. I did a reevaluation on Intel, and this one is going to be interesting, guys, and here's why. When we zoom in on Intel, I did a long-term analysis on it, and as you guys can see here, this is the line I was very, very concerned Intel breaking, and they broke it, and they broke it hard. Basically, this was sitting at, call it $26 a share. This was a line in the sand that I said, if it got broken, something big's going to happen. And the big thing that took place was, I honestly think this is now going to be a substantial line of resistance. I basically have $22 to $19, an area of where I think you might want to consider accumulating from a technical standpoint. I really find it hard to believe we're going to break below $19. I'm not saying it can't happen, but I have to believe that different type of money is going to come in here and put a bid underneath this. This is a historical line of support that we have to consider for Intel, going back friggin' 20 years. So, you know, people that have lost money in it, I'm sorry. But for new investors that are maybe wanting to take on a little risk and take a look at it, my fundamental analysis came in around $17 to $19. My technical analysis is saying this might be a good area to start looking at here, this line of resistance and support, basically from $19 to call it 21 and change, I believe. Yeah, we'll call it $22 to $19. So kind of where it closed today, I think we're going to see it possibly break below this and be really choppy, but this is an area where I think you can start looking at the stock. It looks like on the longer term charts here, it looks like it definitely wants to move down. On the 20-year chart, everything is pointing down. Nothing's really telling us this is a bottom, guys. So I want to make that clear. We need some sort of bottom to take place here. And how we know we're getting to a bottom is you want lower volume coming through and still seeing that selling pressure coming through, but you want to see some sort of W formation or reverse head and shoulders pattern, okay, where we get we get this consolidating and then we get one more washout for the head, and that might be where we kind of start looking at it. So if we get some selling off here and we hold this $19, but then we get a day of a washout where we break below that, that might be a great day of accumulation there. That could form. That's telling us that we're getting some sort of bottoming formulating here. Obviously, you're kind of trying to catch a falling knife at this point in time. But at the same time, when we think about Intel, and if you guys are getting confused to maybe where you should be buying a stock that you think is somewhat quality, it's always good to kind of think about book value and what is that telling us. It's kind of telling us the assets, the liabilities of the company, and trading below that book value if you're having a hard time finding the fundamentals, which this one is very hard. I tried to do my best in the last video. Book value is kind of always an area to go off of, and anything below, 30, 40% below book value on a company you think it might be still have some fundamentals, still have quality, like clean balance sheets, still have some sort of, operating income that's growing or has some future ahead of it. That's somewhere to look. It's not a great area to look. I would always recommend, taking your analysis and plugging them in. I think that's always the best way to go, and then lining that up with the long-term price action. And then so that's what I'm doing with you guys today. Long-term price action, I think it's in an interesting zone. I think $19 is ideal. The break below $19, I'd be looking to average a little bit more, and understanding that, it could get uglier. But I also think there's still some opportunity with this company longer term. If anybody has any stocks that you guys are looking at, please let me know. I said I would take a look at the TLT. We're going to bring that one up next. So TLT is up. Actually, the TLT looks really good right now. So maybe it does have more move to the upside here. This looks really strong. Okay, let me pull up the TLT here. Appreciate it if you guys can give me a thumbs up if you haven't already. All right. So, as you guys heard me say about Intel, that W pattern or reverse head and shoulders pattern, and that's exactly what we have in the TLT, I believe. So if we were to look at this as there's a shoulder here, the head is here, And then we got a right shoulder building here. That is pretty bullish, guys. Maybe we do come up to 120, 121. It has a lot of movement here on the longer term chart. I'm going to bring it down to a 1 year chart here because that's a long time frame. So on the 1 year chart, we'll go 3 years. You can see it clearer on 3 years. So we're going to do a weekly chart here. And once again, you know, you got that W pattern that I talked about before, that W pattern, but I believe you also have a head and shoulders pattern as well. So I do think we're going to test this trend line here at 102.50. I think that's probably going to be a point of resistance. That might be where TLT settles in at, that 102. Maybe it breaks a little bit above it and we can start looking at 106. So I'm going to move this up to 106. So we have a 1 and a 2 count on the Tom DeMarks. So we could be getting a complete 9 count on the TLT, which means that there's most likely more upside movement here on the TLT. And if that's the case, then maybe so here's where you guys have to kind of, you know, look at everything as a whole. So if we're seeing the TLT sell off, could mean two things. From a true macro standpoint, I think this is awful. But from a stock standpoint, could be bullish in the short term because people's initial reaction is going to be the 10 years coming down. That's good for stocks. But as we saw, the 10-year crashed and the stock market dipped 2.25% intraday. It's going to be interesting to see. What we're going to have to do is we're going to have to line up the VIX as well. So what I want to do is after we talk through the TLT, I want to talk through the VIX really quick. So let me see here. I like Fortinet. Whoever called out Fortinet, that's a stock I do like. All right. So TLT to me built a bottom in here. You got a left shoulder, a head, and you got a right shoulder that just built out here. And I'm guessing we're going to hit, call it 107.25. So that's where I would think we're going to tap out on the TLT. So I got a line of resistance at 107.25. If we bring that down to the technicals, that's about where TLT is going to kind of start running a little hot on the RSI. So that's where TLT, I think, will start running hot on the relative strength index as well. Okay. And you're getting a little bit of a divergence on the McClellan oscillator. Okay. So you get a little divergence on the McClellan oscillator, which means I think 107 to call it 110. So 110 to 107, I think we're going to have resistance in the TLT, which would probably make sense because that's where that 3.5% on the 10-year probably makes sense. So everything's actually lining up from the beginning of this video, guys. So I kind of gave my thesis on what I think is going to happen with the S&P 500. I think we're going to chop another 1.25% down, get closer to right around 8-9% down. Historically, that's been proven to be really, really accurate. If you get a 5% move or higher, expect an 8 to an 11% move down. Okay, so I think we're going to get that. I think that hits the 200-day moving average, and I think we start building the right shoulder on this top on the market. I do believe we're in a topping process, so that's just my thesis. I don't believe that we are in a bottoming process. So I do believe that most gains could be in at this point in time, guys. Now, that doesn't mean individual names can't outperform. That just means the indexes as a whole, I think we're closer to a top than a bottom. So TLT, we said we would hit the VIX. All right, let's take a look at the VIX. Now, the type of move that the VIX made, guys, to me is it's a very low percentage move that the VIX makes. We don't see these types of moves very frequently. When we look at the VIX move, it moved 42% in under a week. Okay, that's That's a like a 1% move as far as I understand. Look at this move in the VIX, guys. Okay. This move in the VIX is, to me, is overdone. 87% move in the VIX. 87% move in the VIX in how many days is that? A couple weeks. 87% move in the VIX in a couple weeks. Whoever bought insurance, bought some, VIX calls around these levels. Kudos to you. Historically, that's a good area to buy when you're seeing the VIX run this cheap. It doesn't hurt to take a few percentages, like, 1% to 2% of your portfolio and buy some insurance on the VIX longer term. It's usually a good indicator, a good move. This move here, I think it's overdone. I think we'll see markets rebound, possibly next week. So with that VIX with that kind of move in the VIX, I believe what we're going to see next week is, it might be a little choppy. I think it'll be a relief rally that takes place. I think the VIX is going to cool off. I think the selling pressure, might have been overdone in a short period, but I still think we're going to chop downwards. Okay. So maybe we go up 0.5%, we chop sideways, we consolidate, but I do think that we are probably going to see another move downward overall over the next few months. And then I think we start building out that right shoulder by the end of the year, and into next year is where I think we're going to have the problems. So that's kind of how I see that playing out. But of course, once again, guys, just my opinion. Looking at Fortinet, which companies do you like in the sector? I did buy a small position in CSE in the past few months. So I do like Cisco. I really hope they don't disappoint. When you look at the asset of, if you were to separate the asset of Splunk right now, and they bought Splunk for $28 billion, and Splunk's doing more revenue than Snowflake, it's doing more revenue than Fortinet, it's doing more revenue than Palantir, what would that sell for in the open market if they were to sell it? And I think it would be probably close to a $40 billion valuation, $50 billion valuation if they were to sell it in the open market, and they bought it for $28 billion. So if you were to separate Splunk and you were to separate Cisco's core business right now, I think you would actually get more appreciation reselling the Splunk acquisition back out on the open market right now. So when I look at Cisco as a whole and all the assets underneath it, and the possible AI demand needed to build out, when we think about all the hardware that's needed, and now they're adding that software, that SaaS side of their business, I really like the hardware SaaS complementary side of it. And if you were to separate the assets, I think the assets separated is worth more than the whole right now, but I think the market will eventually figure that out. It could take, I said this could take 4 to 5 years to figure it out for Cisco. Fortinet, I do like. I think you're getting a value. Cybersecurity company here that has a bright future. But the chart looks awful. Chart looks awful on it. So let's pull up the chart. Let me see. Hold on one second, guys. Let's get you over here. Okay, so this is a chart right now of Fortinet. And I did a fundamental analysis on them, so I'll pull that up as well. You just have no need to rush to this right now. It's in a clear downtrend. It's actually in a clear down channel, guys. This is a very, very clear down channel. Okay. Let me brighten those up. It stinks that I have to keep brightening these things because it looks awful from your perspective, but I can see it clearer from my perspective. So if I were to take my emotions out of the equation here, who asked this question about Fortinet? So Dave, if I were to take my emotions out of this and just say from a charting standpoint, there's a lot of things going wrong with this company right now. Okay, so first and foremost, it's in a clear down channel that really hasn't had any sort of break. Now, could we see earnings really surprise on 8/6, which is next week? Could we see earnings surprise on 8/6? Definitely a possibility. You know, it'd be interesting if it tests the bottom of this channel to buy calls on earnings. Dave, where's Dave? Let me see. I want to make sure. So Dave, looking at this, Dave, put in the comments if you own this stock. Okay, I'm going to put a disclaimer out there right now. Dave, put in the comments if you own the stock. I want to put a disclaimer out there. So when I look at this chart and I look at where earnings are coming in, a few things I want to talk through on this one. If you want to have some exposure for earnings, I would use options on this. I would use options on this on earnings. I just want to make sure I'm not missing anything. $56.04 seems to be a pretty good line of support too. It might be at the end of this downward channel, Dave. And then I'm going to pull up what I came out with on a fundamental analysis, okay? So I'm going to give you a rundown on this. I honestly would probably buy cheap options before they report, like the day before they report, or you might even want to buy them at the beginning of the week if the market looks to stabilize and we see that VIX come down. You might want to buy them at the beginning of the week because as we get closer to earnings report, you're probably going to see more expensive options. But I think you have a pretty good line of support here at, call it 56.06, 55.95. It has a one move to the downside. It's below all major moving averages. I would see if it holds this level of 56, Dave, before doing anything. If it breaks below 56 and has a good sell-off before earnings, I would probably buy some option calls just to have a little bit of exposure to it. When I look at what I did for a fundamental analysis on it, I honestly think it was in the 40s personally. But let me pull it up just to make sure I'm not misquoting. I don't want to give you guys anything misquoted here. But Fortinet is one that when we look at kind of all the cybersecurity companies out there, they're kind of one that I can get behind the valuation on a little bit. So Dave, I'm way off on this one. Good thing I didn't quote it. I just want to check their revenue growth and margins because I have a pretty substantial difference on this one. So hold on one second. I just lost it. I got 16, 17 windows up here, guys. Hold on. Bear with me. Where is it? There we go. Okay. I want to just double check something, Dave, before I give this. So this is kind of where I'm at on the stock, around $32. Let me just double check this, though. Let me just double check this. Dave, if you know what they're guiding for, can you type it in the comments? Because I haven't updated this one in over a year. Okay. So, if you guys like, this is the crazy thing. I did this about a year ago when the stock was between about $60 and $70. Might even have been more than that. Yeah. So guys, I did this analysis about right in this time frame here, 60, 70 bucks a share. And now it's at, and I got a price target around 32 bucks, and now it's at $58. Let's see what the forecast is on it. So you have a price target as low as 50 and a high as 80, 85. Guggenheim recently downgraded the stock. They're guiding for 6.6 billion in 2025 and doing $2 a share, 7 billion. They're growing 6.6. Maybe I can bump that up a little bit. Yeah. Okay. Okay. So just kind of messing around here. I updated it. It's closer to possibly a $35, $36 price target, guys. That's them growing 12, 10, and 5%. Now, I'm probably being a little too harsh on the company. They could probably go closer to 6%, 6 through 10, 6 to 7% probably makes sense. So let's bump that up a little bit as well. This is one I haven't done in a while, so forgive me, guys. I'm just kind of running through the numbers really quick. Are they buying back shares? They are buying back shares. Roughly 2% share buybacks. Share buybacks. Cash growth, revenue to free cash flow. All right, let's check. EBITDA margins are sitting at 26. All right, Dave, I think your $40 price target makes sense. So I'm just below that. I think between, call it $34 and $39 is ideally where I'd be looking to buy this stock. So I haven't updated that one in a while, so forgive me, guys, on that one. But yeah, that's one I haven't really looked at. That's one I haven't really looked at in a long time. So I guess that's about it, guys. I'm probably going to sign off here unless if we have any other questions. I'll give it a minute here in case of questions start rolling through. But wanted to go over the technicals, line up what's going on macro here. Yeah, I definitely think we're closer to a top. When we start thinking about the market moves, the way that we're seeing the 10-year, the 2-year trade, when you see yields drop like that, that is not a good sign, because what that is telling us is that there's a repricing of paper because people are flocking to safety, and that it's coming out of risk assets at that point in time, because that money has to come from somewhere, right? So when we see that take place, it correlates, those big moves like that correlate with bad economic outcomes. When you get good economic outcomes and you get a Fed lowering rates, then that's very, very dovish. That's a bullish move in the market. So that's a different type of rate move. But when we see those rates move off of bad economic data, that is a flock to safety, and that's taking taking money out of risk assets and moving it into something safety and locking it up for 10 years. So that tells a lot of people that they're taking their gains, they're walking away because the economics are softening, right? And now it becomes a tale for the bulls, thinking that this is the Goldilocks situation. They want unemployment to go this route. The question now becomes, can they really control unemployment? And the answer is no. So when we think about all the jobs that have been created, it's been government jobs, it's been healthcare jobs, and it's been services, right? And what's the first jobs to go is going to be services and government jobs, right? So when we think about the government deficits, government jobs, I don't know how they're gonna, they're gonna have to make cuts somehow in order to sustain these debt levels. But guys, I guess I'll sign off here. Really appreciate everybody's time. Thank you guys so much for spending it with me, and make sure you like and subscribe, and we will see you in the next one. Peace.